Today we're going to explore the highly effective strategy known as self-directing, or harnessing your retirement account as an investment vehicle. At Sunrise Capital Investors, we're all about helping as many people as possible generate cash flow and build legacy wealth. And self-directed retirement accounts can be an extremely powerful tool to help you do just that. Folks often have a certain blind spot associated with retirement accounts. People feel that they're kind of out of bounds, if you will, when it comes to investing. But this couldn't be further from the truth. People have the ability to take control of their financial future by taking control of their retirement accounts. People often are under the impression that you're locked into traditional investment vehicles like stocks, bonds, mutual funds, and ETFs. But the fact is, as far as asset classes go, life insurance, S-Corp shares, and collectibles are really your only limitation. So you can't go out and buy Picasso paintings or any of the Honus Wagner baseball cards that you love. But outside of that territory, the world really is your oyster. And investing in real estate, it is one of the most safe and profitable options for self-directed investing. With a self-directed retirement account, you're no longer beholden to traditional custodians like Fidelity and Schwab. You're in the driver's seat when it comes to your investments. You can transfer your funds to a custodian that actually empowers you to take control of your investment choices. And once you've made the switch, apart from the assets that I just mentioned, you can invest in virtually anything that you deem a worthy investment, with one minor caveat. If your IRA or 401k is still with your current employer, the plan needs to permit what is known as a quote in-service rollover. That allows you to distribute the money outside of the plan and assume full control for yourself. If your employer's plan doesn't permit an in-service rollover, then unfortunately, self-directing while you're at that company, it's just not feasible for you at that time. Let's delve into some important concepts here. Number one, your retirement is basically its own man. You have to think of it as its own entity. I guess man or woman, I should say, right? Sounds funny, but it's true. And you and your retirement account are distinct entities. You cannot directly benefit from your retirement account, and the retirement account cannot directly benefit from you. For example, out of all the different real estate investments, you can't go out and buy an Airbnb and then personally rent it from your retirement account. Also, if you invest in a multifamily syndication kind of as a limited partner, you can't be actively involved in the day-to-day management whatsoever. All of this is to say that any of the income that is earned inside of the self-directed IRA account must be totally passive, and any of the expenses incurred must be paid directly by the account and not by you. Otherwise, you're dealing with an extension of credit, which is a no-go from the IRS's perspective. Let's discuss the concept of a disqualified person. A disqualified person is somebody that your retirement account cannot transact with, can't do business with, which means things like buying an apartment complex and actually staying in one of those respective units, even if you don't charge that individual. So, quick question here, who would be the first person that would not be allowed to actually rent that respective unit? You guessed it, you personally are a disqualified person. Other examples of disqualified persons would be parents, grandparents, children, and grandchildren. These groups are known as linear ascendants and descendants. Spouses, they are also forbidden. However, brothers, sisters, aunts, uncles, nieces, and nephews, those are all 100% permitted. So I don't know who drew the arbitrary line there, but the IRS had to draw a line somewhere. Remember how I said that you need to think of your retirement account as its own person, as its own man. The same concept applies to any of your disqualified persons. Your spouse, they may be a disqualified person, but their IRA or their 401k isn't, and that's an important distinction here. The same applies to anyone else on the list that we just covered. That means that both of your self-directed IRA accounts or solo 401k accounts, they can invest in the same deal so long as everyone involved is doing so with their retirement funds. You can even pool funds together, pool retirement funds together in a holding company. This is a strategy that many of our investors use to often increase their investment potential. For instance, if the minimum investment amount in an offering is $100,000, whatever the case may be, you could pool your accounts together in one entity and each only have to contribute $50,000 to become eligible. So if I could boil it down to maybe one concise sentence, it would be this: always mix retirement accounts with other retirement accounts and never outside cash. That wraps up our introduction to self-directed retirement accounts. In our next video, we'll explore the different types of self-directed accounts available and which ones you're eligible to use. We look forward to guiding you on this journey to real freedom through passive investing.